Good morning and welcome back to Almus Market Mornings. Okay, so this week, a lot of attention has been on the tech sector. As we have repeatedly highlighted, it seems investors are worried about lofty valuations, and on any minor worry, we are seeing stocks tumble down. Despite strong earnings and guidance by Nvidia, we saw risk assets take a good beating. It has extended to today's losses in key Asian markets like Japan and Korea. On the policy side, the worry prevails of Fed not cutting for the rest of the year. NFP for September was released yesterday and was stale, though headline printed strong. Unemployment rate ticked up, but I'm not sure how that would be read. Good morning, JK. What's your read on September's employment print? Do you think it offers any solid clues on the state of the economy, or we shouldn't read too much into it?
Good morning. I think we should not read too much into it. On the face of it, the number of jobs, new jobs created under non-farm payroll was almost double of what was expected, and almost more than five times of the previous month. In the normal course, such a number would have been seen as a very bullish number, but that we have been interspersed with a long holiday, or you can say shutdown of the US government. We do not know what is the state of the economy for the last 45 days that it was shut down. So we should just assume, or rather understand, that from August to September, there was an improvement in the employment situation. That's all I would like to conclude. Of course, the jobless claims data have been updated now, and it is in the region of 2,20,000, and it's fallen actually away, by about 8,000 from the previous week. That is not giving much of a concern, but that is, I think, we are more concerned with the monthly jobs data, and so I think we should wait for middle of December, by when all the updated data would be published. Now, I think more focus was on what was happening in the asset market. In fact, the risk assets in the US have been, or across the globe, have been under some pressure. Just to quote one of them, the Bitcoin is down 32% in the last 1 to 1.5 months, and that is actually the leading you know financial product that has been seeing a huge sell-off, and of course it has also been one of them which has risen massively in the last few years. Now, if you look at Dow, it is down 5% from the peak that it saw last week. S&P 500 4.5% down, peak seen a month back, and Nasdaq down about 8%, again peak seen about a month back. Now, important thing note is that the market was unable to hold on to a strong bounce that was seen earlier in the day yesterday on the back of better than expected Nvidia earnings. Now, Nasdaq ending down more than 2% after being up 2%, 2.6% intraday high is something that should be very discouraging for the bulls. And adding to market volatility was on the Fed Governor Lisa Cook also warned that high valuation in stocks, corporate bonds, housing, and leveraged loans increase the risk of sharp market declines. Although she did say that the financial system remained resilient. So, if you remember yesterday, we had warned about the despite good earnings report, it's a matter to be borne in mind that it's all discounted well. So, what the market thought was, what more good news is left? And that is why I would say year-end factor came into play, and having seen good profits already during the last several months, market is tempted to take profit, not seeing it as a confirmation that it is seen its top, although several analysts are calling for one. But I would still wait and see what happens in the next few sessions before that can be concluded. One of the fallout of the market volatility is it's probably raised the prospects of, uh, you know, uh, rate cut in December, because a continued bearishness in the market can lead to more impact on consumer confidence and perhaps the spending as well. So I'm seeing the market discounting probability has risen closer to 40% for a cut in December, uh, from closer to 20% that was seen a couple of days back. What is also clear is that the dollar has been steadily rising. Look at the dollar index, it's closed above the 200-day moving average for 2 days now. And there is a first full day range above 100 yesterday. It has also come above the 2-month-old uptrend line after briefly dipping below it. Now, its strength against yen, of course, has been mentioned by us a lot because the Japanese government has been pushing for a huge fiscal spending, and they are really not concerned about the lingering inflation threats. In fact, today's data also shows the Japanese inflation rate higher than previous month, 3% versus 2.9%. Core inflation also rising. The month-on-month inflation is 0.4% versus 0.1% last month. But while the Bank of Japan governor does say that December cut is on the table, but the Prime Minister is very much on record, saying that Japan should not hurry to cut rates. So that's the reason why yen has been weak, and dollar strength is derived mostly from yen's weakness of late. Although dollar has also strengthened yesterday on the back of against some of the growth-led currencies like Canadian dollar, Australian dollar, even some of the high yielding currencies like Mexican and South African, as well as the Brazilian real, have seen some profit taking. They were all big gainers on the back of high yields that they offer. And carry trade against the yen was one of the major play there. So the dollar has been rising, and there is some also the doubts about Fed whether they'll cut in December or not is also leading to some some buyback of the dollar. Risk aversion is playing its own part. Year-end profit taking on huge dollar shorts by large players. That's also one of the factors. This could continue for a couple of weeks until we get more indications of what the Fed would do, and that will only come with more official data that is coming out. And the market development also needs to be watched. As I said earlier, if the market continues to slide in a big way, that could impact the consumer confidence and also the spending, and that could lead Fed to take a slightly more dovish view on the markets as well. Now, of course, we had also the Japanese finance minister saying they will take appropriate action based on US-Japan forest agreement, and intervention is one of the tools on the table. But I think that is not uh, something that the market is trying to expect right now, because they have not really followed up their words with actions. Yes, we did see 157.90. Crossing 158 might probably increase those nervousness, but not right now. As far as India is concerned, I think inability to hold any dip is once again evident. This time more on the back of global factors, and of course, importers are ever present on dips to 84.40 and 88.40 and below, and this will continue until we get some solid news on the trade deal, about which we've been hearing so many updates, but nothing really solid has come out. And of course, Indian stocks, or while they have not seen any outflows so far, we perhaps the markets or the FIIs will also take a cautious stance to see where the global markets head in the next few weeks. Perhaps a bigger correction in the global markets can also see the Indian market see one more bout of correction. But overall, seems like more and more analysts are now in favor of re-entering the Indian market, and that's a good news as far as the flow is concerned and for the rupee. But for now, 88.30 and 88.80 will define the range, and any break of either only will lead to some trendy move. Thank you.
Thank you, JK. And yeah, so it's the global risk aversion kind of scenario. That's what we are looking for. Equities, not the preferred assets as of now. One interesting thing, of course, JK mentioned is that Dow and S&P, they are already down 5% from a month back, and Nasdaq is down 8%. If we look at high delta assets like Bitcoin, that's down 32% in the last month and a half. So risk assets all around, they are taking quite a beating. And this continued bearishness will need to be observed closely, because US economy and markets are quite interlinked. So if there is a sustained down move in the stock markets, that really affects consumption, and that actually may raise the odds of Fed cutting in December. Dollar broadly has held its gains. The weakness in yen we have spoken about constantly. Even the Japanese inflation print, which was released today, was higher. So it's a scenario where inflation is rising, but policymakers, they seem unwilling to tighten the financial conditions, and also we have big fiscal spending in place, and that's driving the yen weakness. That's a big story that we continue to track. Rupee could not hold on to gains. There are importers buying dollars around 88.40. While globally also dollar has strengthened, it has put pressure on the rupee as well, which traded again close to the upper band of the range of 88.80. Indian stocks, they have not seen any outflows, but there will be caution all around because there is a broader risk aversion scenario. That's it from us today. Thank you for listening. Have a very good weekend. We'll catch up on Monday with a fresh round of updates.